does it really matter if you had the conversation? Does it matter how good your plan is? Probably not if it's not actually being implemented. There is so much that we need to discuss before we would actually dive into investments, at least within our approach.
One of the three red flags for advisors. And one of them is if they don't tell you what they're charging you. So if they're always shy away from their fee, like that's a red flag right away. The second thing is if you don't understand the plan and they keep pushing you to do it, even though you don't quite understand why you're doing it.
Welcome to Retirement Done Right with your hosts, David Rath and Pat Kalish, where we talk about retirement, social security, taxes, estate planning, wealth planning, and more. Now, onto the show.
Welcome back to the podcast. Today, I'm joined with Pat, who's our head of financial planning. My name is Andrew, head of strategic growth. Today's podcast, we're talking about three specific things. One's going to be where the industry was the past few years and where it's going, kind of the history of that. What a fiduciary is. I'm sure you've heard the term of fiduciary around a lot in the industry. What does that mean? Are there good? Are there bad fiduciaries? What's kind of the actual definition in the industry and how it's changed over the years? And the last thing is, what is actual holistic planning? What does it actually mean when somebody says holistic? And what's the definition from one holistic planner to another? And how does it differentiate from each other? So let's say Pat and I are going to jump into that and hope you guys enjoy. If you have any questions or comments, leave it in the comments below. And we'll be happy to answer any questions, or if you have a question around planning, we'll add that to another podcast in the future. So Pat, to start it off, where are we at now compared to where we were maybe 50, 60 years ago?
Oh gosh. I mean, I think first off, I'm excited to talk about this content because I think I've been in the industry for like 10 years and I don't even think my wife kind of knows what I do. So I'm going to send this one to her first. But I would just say like the term financial advisor gets thrown around all the time. And when you think about it, like there's no regulations in terms of the actual term financial advisor. You could be a broker, you could be an insurance agent, you could be someone that actually really does pride themselves on more so holistic financial plans. So I think it's really important to not only know, the difference of services that can be provided out there, but also maybe some questions to ask your advisor or prospective advisors to see if it's the service that you're looking for. Because you might not be looking for a holistic financial plan. You might just be looking for an investment manager, and that's okay. But I think it's important to kind of have some clarity in terms of like what you're getting yourself into, because it's such a big decision that people make. So excited to dive into it.
Yeah, I think, the industry has changed so much. And what people think we do for a job is different than 20 years ago, which is different than 50 or 60 years ago, where we had stockbrokers, right? And everybody comes to me like, oh, you work in the finance space. Like, I'm sure you look at tickers all day. What hot investment advice do you have for me? What stock should I buy? Like, should I buy the Nvidia? Or should I buy Palantir? Or should I buy these like tech stocks? And like, one, that's not what I do. I could probably, give you some sort of direction if I wanted to, but that's not what we do all day at all. Talk a little bit about where the industry was maybe 50, 60 years ago, and even like kind of the 70s up to the Wolf of Wall Street days, into like the late 90s, early 2000s, and now here where we are now. Talk a little bit about that transition, then we can jump into a little bit more about kind of where it's headed with AI in the future of the planning space.
Yeah, so when we think back to like the 70s and the 80s, I guess that's more of like what you would consider like the Wolf of Wall Street days. And it was basically your stockbrokers. I mean, transactions were more so king at that point. And when you think about it, like people didn't really have access to a ton of information back then. So they had to call somebody that basically had the access to be able to quote them out different stock prices, maybe give them kind of guidance in terms of what stocks to buy. But I think at that point, like I said, like transactions were king. And a lot of times stockbrokers, I mean, that is how they were paid. So that is really what they focused in on with the clients that they worked with. But like over time, it definitely, the industry has changed. So when you think about, call it like the 1990s to the 2000s, I would say that was like the rise of mutual fund and insurance reps. So, like, it changed from transactions to more like product sales. And we could talk a little bit more about like how advisors at that point were actually getting paid in terms of mutual fund transaction fees and insurance fees. but it was all about product sales. And then finally, I would say it probably started to happen more so in like 2010 all the way up to now, like registered investment advisors, small business owners, and fiduciary planning really started to take hold. And that's when I would say the industry started to get away from just transactions and product fees to more so what you see today, which is more so like holistic financial planning. We're not just focusing in on the investments. That's only a small sliver of what a lot of advisors are talking about. But with that being said, not every advisor is a holistic financial planner. Some are still focused in on product sales and such. So the industry has changed, but there's still a lot of kind of the old school type advisors out there that are still very successful and
Yeah.
we'll partner with them.
Yeah. I always joke there's more. I don't know what the stats are. I get this wrong. I could probably Google it and look it up and prove me wrong. But there's more advisors over 70 than under 30.
I believe.
I'm pretty sure that's the stat. And that's due to, and me and you probably had this similar experience potentially. But for people at home who don't really know, the industry, it's like if you walked into, have no idea what the medical field looks like, and you hear the word doctor, you think every doctor is the same. It's not the case. Same for financial advisors. People think, oh, you're a financial advisor. You're just like every single one is the same. If you're a fiduciary financial advisor, you're all the exact same. But the problem is, and we talked about this like a few days ago, if you're a fiduciary, like if everybody says they're a fiduciary, then no one's a fiduciary potentially. And if everybody's a fiduciary and I go to 10 different advisors, how is it the case they get 10 different plans and 10 different products potentially to sell me? So if everybody's looking out for my best interest, all of a sudden everybody's different. So how is that possible? If everybody's access to everything, right? And somebody's like, you gotta do this or this or this. So that's something that people don't really know about. And there's also like the broker dealer space and RIA space. Do you feel comfortable chatting a little bit more about kind of those two differentiators and even like the hybrid model?
Yeah.
I know you're more like the Vanguard space, but there's the broker dealer space. People like are like, what the heck does that even mean? But in the finance space, it's a pretty common term. But just go through kind of that difference.
So I used to be a wholesaler for Vanguard. So I actually used to cover broker dealer advisors. Typically, like to keep it more so high level, when you think broker dealers, think about your big shops. Think about like your Merrill Lynch's, your Morgan Stanley's, your UBS's, or your Wells Fargo. So, for example, and typically they have financial advisors that use, call it the bool at the top right of their statement, and, it doesn't mean that they're purely investment advisors. It doesn't mean that they're purely holistic financial planners. They basically then just have the backing of those larger institutions. So a lot of times, like when they're looking for resources and research or the trading platform that they use, that's all going to be combined under, call it that larger company. So they have access to a lot of resources, which makes it, an attractive offer. Then when you flip gears, what a lot of people call it like RIA, and RIA stands for Registered Investment Advisor. And when you think about that term, think about more so like smaller business owners that don't actually have the, call it, resources that a Merrill or a Morgan Stanley might have. But with that said, a lot of these, I call them like small business owners. I mean, a lot of these RAs have really grown over time and they're like big billion-dollar type businesses. But then they have access to the products and the resources and the research that they want to use. So they're really catering their offer to their client demographic. So at Continuum, like for example, we're a registered investment advisor, but it allows us to really cater our offer to our client demographic. So we really work with pre-retirees and retirees, and we are really looking to make sure that our offer is very unique and customized because we are able to kind of build that out through our platforms and we don't have to answer to this larger institution. Um, it's two ways to skin the cat, so to speak.
Yeah. I was originally in a broker dealer for 6 months and it was a lot of this like product pushing, which I didn't like. It was like, you have to sell this product for this person in this situation. It's like, I don't know if that's really what they need. And it was like all commission based. And basically my problem was like, I had to pitch kind of their product, or otherwise I really wouldn't get paid. Like I would have made, I would have made like 5 grand a year if I wouldn't have pushed their product. And if I would have, then I would have made, 5 times that much or 10 times that much out of college. So it's like, they have their, which is fine. They have their stuff, totally cool. But I've seen this great exiting of the BD space to the RA space the past 10 years, even like 5 years. Because the RA space was newer. And originally, you mentioned 2010, it wasn't really baked out as much. Advisors didn't have the resources, and now advisors can go build their own RIA, have maybe a couple $100 million in assets, and then they can pick and choose tech to add to their RIA because there's technology out there where previously the broker dealers and the big companies had the technology. If you want to go out on your own, you didn't get access to it, but now it's accessible to everybody, which kind of pays, uh, or goes into what we talked about with the clientele of that relationship's changed over time as clients have been able to get more information and access to more information, like the stock pitching in the kind of the stock market in the 80s, 90s changed because people are all of a sudden able to like buy their own stocks. And then as they get more access to more information, the planning changes a little bit where we have clients who do their own trading now. Like obviously we're not gonna call up and say, hey John, we have a hot stock tip for you today. That's just not what we do. That's kind of changed over time, but as things change, you mentioned kind of the 80s and the early 2000s and then now, that's impacted how advisors get paid as well, as far as like commission to fee plan to flat fee. Talk a little bit about, back in the day of slinging a stock versus the commission based to kind of where the whole industry is going now, and mention a little bit more about, the commission products or commission shares. Then it's like AUM fees, kind of how that's transpired and it's kind of changed the past like 25 years.
Before we go there, I don't wanna, I wanna go back to, like, broker-dealer, RA. I think the one thing that I would say is, like, you need to find the right advisor, no matter if they're represented by a big company or a small company. And I say that because, it all just really depends upon the person that you find, the trust that you build, and the offer that they represent. So like when I was looking to leave Vanguard and go more so into the financial planning space, right? Like I looked at multiple different companies. And the reason why I chose Continuum is because first off, I feel like they really care about their clients. They cared about the people on their team. And I thought that their offer was extremely strong. And what I noticed at Continuum is the focus wasn't just to bring more and more people in, which is a lot of times some of those larger firms. I mean, it's the law of numbers. They want more and more assets. But with Continuum, it was more like we need to do what's best by the people that we are serving. And yeah, we want to continue to grow. That's an important part of our business, but we want to have the best offer. We want to make sure that our clients are comfortable and confident in their approach moving forward. And that's what attracted me to Continuum. And I've liked that we are a registered investment advisor because I've even been able to have some impact, during my tenure on this team of saying, like, let's look into this service. Like, I think we should go deeper into tax planning. And I don't need to go to this big firm and ask if we can use Holistiplan, so to speak. Like, we can make that decision and actually roll that out in a very, prudent and efficient way so that our offer just continues to grow. So I just wanted to say that.
Yeah. One thing that stuck out because I'm obviously part of Continuum as well, and the growth officer, Tim, who's the main partner, our majority partner, um, he said to me, we never want to grow fast enough or too fast or overgrow where we can't serve our clients, which is kind of an oxymoron for me because I'm like, my whole goal is to grow. So it's like, all right, we need to grow steadily in the right way and not grow too fast. We're all listening to get out over our skis. Can't serve our clients. We bring somebody on, we drop the ball on stuff, whatever it might be. So that was really important to me because a lot of firms I worked with, it's like, we're going to grow and grow as fast as we can. And like, we should get people at as fast as possible. We need to hit this number and this metric. And for us at Continuum and Tim, it's like, we want to grow totally. That's like the goal of business. We want to help more people and serve more people and grow our firm. That's super fun, and important to us and a priority. But priority above all is like, we want to serve our clients. That's why we're in the business. We're not in the business. The purpose of the business is not to grow. The purpose number one of the business is to serve people financially. And that's the number one goal. And if we can't hit the number one goal, then we need to take a step back and figure out where are we dropping the ball? What do we need to tweak? Is it our growth? Is it our technology? Is it our systems? Is it our communication? Where's the ball getting dropped and focus on that versus, hey, we need to bring in 100 households a year or we're not growing fast enough, which I thought was a different tune than what I've heard in the industry a lot. and I've been around a lot of advisors, a lot of firms, a lot of advisors in my day, and everybody's like, "You got to grow as fast as possible." I'm like, I mean, I get it, but I'd rather grow steadily in the right way versus run the wrong way. And all of a sudden, you drop the ball, you know.
No, I agree.
So
All right, you want to talk fees? All right, let's break
let's
this
talk. Let's talk fees. Yes.
commissions, products. Let's break it three things: commissions, product or platform fees, and then let's finally talk about like assets under management, AUM,
Yeah.
for example. I think that's what a lot of people are running into these days. Commissions are a little bit old school. That's they're still out there, so it's still something to be mindful of. But basically, think about it: you're paid like the advisor is paid for selling a product, whether that be a mutual fund, whether that be a stock. And basically they are incentivized to sell more products. So the more they sell, the more that they earn. It's not one thing like we don't have commissions at Continuum. A lot of firms are actually kind of leaving that style of overall, fee structure, because is it really in the best client's interest when you are really paid to sell more products? It won't.
Which is important to note a lot. People don't know how their advisor gets paid a lot of times, which is something we'll hit on later in the video on like questions you should ask your advisor, which is really important. But the incentive is always there for people, and no matter how people talk, they're always gonna go towards incentives. That's what I see in the industry, whether it's good, bad, or otherwise. But if there's a fund that's maybe a 5% load fee, and Pat, you can talk about that in a little bit, but a 5% fee up front, that's maybe okay for you, maybe it's a B for you, versus there's another fund that's only a 3% load fee and it's the best for you, that advisor might be incentivized to put you in the first one where they get paid a little bit more, even though it's, maybe a little bit worse for you. They're like, people won't know the difference. It's going to be similar, kind of a similar stock or similar ETF or similar thing. But I've seen it a lot of times where people just like toss in all these funds because they're getting paid 6.5 or 7% on the front end. So speak to that a little bit more. I didn't want to jump the gun, but want to make sure people knew like you need to ask how your advisor's being paid. And if they don't tell you or are kind of like shying away from it, it's probably a red flag. You need to, yeah.
Should be transparent. It really should be. And you should, feel empowered to ask the question because you need to be able to see the value of what you're paying for. You also got to be mindful of like product or platform fees. And I say this because sometimes these are a little bit hidden. Sometimes with commissions, like you see them, it's a line item, right? So, 7.95 for a stock trade, whatever it might be. The product or platform fees are kind of like a hidden toll along the way. So those you have to be mindful of because they're not going to be so front and center. So it's another question to ask of like, are there any additional product or platform fees that I should be aware of? Because when you think about fees, like every fee you pay is a drag on your overall long-term performance. So trying to keep those as low as possible is extremely important. And then let's talk assets under management or AUM fees. This has become a little bit more common. So basically, your fee is based upon the assets that advisor is managing for you. A lot of times you'll see these fees on average are about 1%, but I think the whole idea was it aligns the advisor and the client in theory, right? So
Yep.
like if you're managing an account of $1 million, you're getting paid a 1% fee. That fee is $10,000 a year. If your account continues to do well, it doesn't mean that the 1% fee goes up, but the advisor's collecting more revenue because there's
Right.
assets under management. And then vice versa. If the market, pulls back, right, less revenue for the advisor. Um, but here's what I would say about an AUM fee or an assets under management fee. I think it could fall short if the offer is just predicated on investments. Right? Like, I think that fee should extend out to that more of an offering. So beyond just investment management, like, what are you getting in terms of potential financial planning? What are you getting in terms of tax management or estate planning type management? So, really, I think in terms of if you are sitting in front of advisor and they're charging you an AUM fee, understand like what that covers beyond just investment management. I think that is so important.
And I think that's changed a lot the past 10 years or even like 15, where, like I talked about earlier, people have access to trading now. They're like, well, I can go trade the same ETFs that you're trading for me. So why would I pay you 1% to do that? Especially like, there's some bigger firms that are like just investment ETF focused. And they're like, oh yeah, we do some tax planning too. And it's like, one, your tax planning isn't that good, in my opinion, or our opinion, maybe. Not to talk shade, but like your state tax spending, but it's like you just kind of say it to say it versus like we do really in depth, really good stuff.
Yeah.
And like everybody wants to just be able to like the people want to have control over their money a lot of times. And so like they can go trade their state mutual funds for whatever the expense ratio inside the fund is without having to pay an advisor to do it, who they only talk to once a year, an extra 1%. Because an extra 1% a year is huge. And I think people at home should audit. Um, they should do like a once a year or every few years audit on their advisor, just from a cost standpoint, making sure that they're doing what they're saying they're going to do. Because I've seen people, I have a buddy's dad who I was talking to, and he just did an expense audit. And he's like, yeah, I'm paying 2% all in on my fee in my account. And I thought I was only paying like, I think he said he's paying like 1.2 where he thought he was. He's like, yeah, I did an expense audit, and I'm actually paying 2 because I was paying a 1% fee to my guy and a 1% fee on my funds, and then 2%, which is a huge deal. And I think you need to make sure too, I've seen this, which is illegal, but you need to make sure that you're not doing it. Um, Make sure that they're not getting commission on it and charging AUM fee.
Yeah.
You can't do both. And I've seen people who have come to us, at previous firms. I saw people who came to us with a different advisor, and the advisor getting commission on a product that they were selling, and they were charging a fee on it. But people either don't look at the statements, or they just, are just not careful enough to look at it. But just for people out there, just make sure that you're auditing. It's just important to look at what's going on behind the scenes, because most people are good in the industry, like most people, but there are some people who might kind of do some things in the back end that aren't always aligned. So
I'm glad you brought up actually like looking at like it say you have an AUM fee. Say you're getting paid an AUM fee. Also looking under the hood to see the fees on the products that are being used. I actually think that's huge. And I think a lot of people miss out because a lot of times the fees on the products that are being used, say it's ETFs or mutual funds, their expense ratios. And you don't see those fees coming out as a line item. That's baked into the cost of those overall products. It's based into that, net asset value they called. So you could, like you said, be getting charged a 1% management fee, and then your product fees that you're really not seeing could also then be 1%. So in totality, you're paying 2%. So I think that's a huge point. I think that's one that's being really, missed within our industry. I'll say this, like I don't predicate our service. I don't sell based on us having a lower fee because at the end of the day, I think we provide the value at Continuum. So that's what I want to talk about. I want to talk about our, expansive offer, but it is something to definitely keep in mind.
yeah, I was gonna say I never fee chase, but it's just not something we do. I just want people to know that like there's some costs baked in that you might not realize. And if you do want to go look up your costs, if you go to your statement, you can literally look up the ticker symbols, which is kind of like the 3 or 4 letter symbols on the stock. So like SPY is a common ETF, just a S&P ETF essentially. But if you type in SPY online and go to Yahoo Finance or some other websites, you can see the expense ratio in the stats. And that expense ratio is the internal cost. And so you're paying that on top of whatever the advisor charges you. So let's say the ETF is 0.2% and the advisor charging you 1%, all in you're paying 1.2%.
Yep.
So that's just something to talk through, make sure people understand kind of how that works, because people just don't quite understand all the time. So
The other thing we actually missed when I was telling you what we were going to discuss was also like flat or planning fees. That's a new one.
that's a big trend.
Well, yeah, it's like think advisor AUM model versus the flat or the planning fee kind of go, hand in hand and go back at it. Here's what I would say is like basically what that is like think of it like think of it like a fixed fee or maybe like a subscription model at the end of the day. Like it's a flat fee every year, so that that advisor can kind of do some like overall planning for you. And a lot of times when you look at like flat fees or those types of subscription models, they tend to be a little bit more holistic. So it's not just investment planning; they're tending to run like a full financial plan for you. Um, my only qualm there is that what I have seen is that a lot of times the implementation is so difficult, that I think if you kind of can do that for a client, right? And make sure that everything is implemented and then is continuously tracked because these plans evolve over time, right? Like that is worth paying for, in my opinion. Uh, so that's another fee out there. That's becoming a little bit more and more popular.
And you're talking about a one-time planning fee or an annual planning fee?
I mean, there's both, right? There's one-time fees, there's annual kind of call it like subscription fees. But even when you think about we talked a lot about investment management. If you have a really robust process and you're proposing a very robust portfolio, typically those portfolios change. So if you're not, if a client is only paying an annual fee, but they're not actually keeping up with the changes that need to be made in the portfolio, does it really matter if you had the conversation? Does it matter how good your plan is? Probably not if it's not actually being implemented.
Right. Yeah. I mean, it's a trend now, and it's some people are able to do it. Some people kind of pick and choose depending on their clientele. I have a friend who has an RIA who's in his lower 30s. He only does planning fee. I think it's like 5 grand to 10 grand depending on what you want to do. Because he's like some tax stuff and estate planning software he'll use and that kind of thing. But it's just a different approach. I think people are used to the AUM fee, like the 1% or 1.5% fee or 0.5% fee for the advisors charge. I think the planning fee is a newer thing that people are testing out. I think it is plausible and it works, and it's just a different kind of way people can get paid, right? Because if you have, $20 million and you're paying 1%, you better make sure you're getting value out of that because you're paying 200 grand a year for some stuff. You better make sure your advisor's not just spending 3 hours a year on you, I would say,
And
you know?
yeah, no, for sure. I agree.
Um, let's talk about the fiduciary standard because you and I, it drives me nuts. Uh, let's talk about the fiduciary. First of all, what does that mean? And then second of all, if everybody says they're a fiduciary, and why are people fiduciaries? And how can I differentiate if everybody says they're fiduciaries? Should I trust everybody who says that? Should I not trust everybody who says that? Give me the kind of the spiel on the fiduciary term in the financial space and what's kind of going on right now.
Just so I get the question a lot. And let's break it down between suitability and fiduciary. I think that's going to be the easiest way to kind of approach it. So, like suitability, when I think of suitability, is the product okay for the client? Will it work for the client? When I think of fiduciary, like, is the service that I'm providing, is the products that I'm providing the best for the client? Is this going to be the best approach kind of moving forward for this client's, specific situation? The problem is like, fiduciary gets thrown around a lot. And like you said, a lot of people are fiduciaries or can use the term fiduciary. What I would just say from, a very high level is whether or not someone is a fiduciary, like do your due diligence, and ask thoughtful questions to understand like what is their planning offer? What is their process? What is the value that you're going to derive from the services that they provide? And truly try and understand how they approach being a financial advisor for you and your family. You've got to do your research beyond just hearing and them saying, I'm a fiduciary, and then just thinking that you're going to have the best plan for your family. You got to dive deep there.
Yeah. And I don't know if I were to cut this out. I might have to talk to our compliance to make sure I'm not going to get in trouble for what I'm saying. So we have to put a pause in it. But I've seen advisors who say they're fiduciaries, which is fine because everybody's like, oh, I'm a fiduciary. I have this from with this firm. We're fiduciaries, of course. But every advisor can make every product sound like it's a fit. Their job is to sell something. Like their advisors are mostly salespeople, in that they're educators, but at the baseline, they're kind of like selling you on like the services in the plan, which is fine. But they always can go back to their back office and say, hey, I'm selling this to this client because of X, Y, and Z. This is why I think it's the best because of X, Y, and Z. Even though maybe in the long term it's not, but they can always sell it and say, hey, we're going to shape the plan. This is why I think it's the case. Even though there's maybe 100 product selections, I'm going to pick this one because it might be the best. Even though I've seen in the past that it's like, yeah, we're going to split them in this policy. We're in this thing because I know I'm going to make a lot. I'm going to make it just sound and kind of say, I think this is the best because X, Y, Z, even though maybe they should just be in like, start a Roth IRA and start saving a little bit more. but they kind of push something else
I think it's
and just make it sound good.
I still just think it's amazing that, clients will go to some advisor, so to speak, and be like, all right, well, where should I be invested? And the advisor will be like, oh, yeah, invest in this specific fund. It's like, you know nothing about their background. You know nothing about their cash flow needs, their short term, their long term goals, their tax situation. Like, there is so much that we need to discuss before we would actually dive into investments, at least within our approach, for me to actually lay my head down at night and sleep soundly and know, like, yeah, I put that client in the best situation because I truly understand the situation that they're in. And it ain't just from a risk tolerance standpoint.
Yeah. There's three things that I was talking about. And I guess I'll first say if you need to look up your advisor, you can look up the history if there's any complaints against them. And you can look up their basically CRD number or you can type in their name. And it's at brokercheck.com. Is that right? Well, yeah, it's at brokercheck.com. Is when you can just type in your advisor's name and look up if there's any complaints behind them in the past, which is a great place to look. But I actually made a video a few years ago on the 3 red flags for advisors. And one of them is if they don't tell you what they're charging you. So if they're always shy away from their fee, like that's a red flag right away. The second thing is if you don't understand the plan and they keep pushing you to do it, even though you don't quite understand why you're doing it, their job is to be an educator. Their job is to make sure that you're comfortable with it. They need to make sure that you're comfortable with it. If you're not, and it feels like they're pressuring you to do it, you should probably go find someone else, go find a second opinion. And the third red flag is to try to sell you something the first time you meet. Like that's like, if you walk in there and they slide a piece of paper across, like, hey, you should do this policy or do this fund or invest in us, like the first meeting when they barely know you, no way. I don't care how well you know them and how long it's been. If they haven't done their due diligence in their situation and haven't really dug into who you are, like you should not be doing anything the first visit. And we don't even talk anything until like visit 3, really. And we kind of like talk about like kind of where stuff might look. But if people are trying to pressure you to like sign a policy or to invest, move money first visit without them really knowing your situation, that's a huge killer for me. That you should just walk away and go find someone else because it's not appropriate.
Yeah, for sure. Could we talk like what actually holistic financial planning is?
Yeah, sorry. I'm getting a little passionate. I'm getting a little passionate about the industry. I'm just seeing such like shady stuff sometimes. It's like it just drives me nuts. But
Just because it's my passion, but, like, I'll lead with the story too. So, like, me and Liz, my wife, like, we're going through, like, some big changes, like, we're looking to settle down roots, potentially build a home, maybe expand the family, like, who's to know? Like, there's a lot that's going on within our life. So what I said is, I'm like, "I think this would be, like, a perfect time where her and I can, like, sit down and we can kinda go through our financial plan as a family." And I walked her through it, and we didn't talk about investments at all. We talked about crisis management. So, like, what are the term life insurance policies that we have? God forbid something happens, and what's it going to cover? And how are we going to use those funds? We talked about our income plan. So we talked about, our gross income versus our net income and where our income is flowing in terms of savings, in terms of expenses, the whole nine, and how that might change with a house. We talked about our savings plan and like why we're putting money into certain different vehicles. We talked about our house plan, and then we talked about some action items, like action items that we need to get aligned today, and then action items that we need to think about into the future. And when we were done, she's just like, "Huh, so that's what you do."
yeah,
Never really even knew. My own wife and I talk about this stuff all the time because I'm super passionate about it. But, it took her to be able to see this defined plan and to go through it step by step and to really relate it back to her life. And I think that's financial planning. It's not just investment management. I mean, that is important. Do not get me wrong. Like, that really helps kind of grow the ship, so to speak. But overall, it's everything else that takes upon like that, you have to manage from a financial standpoint, where you can partner with someone to hopefully refine that plan and make sure that you're thinking about things in the correct way and then looking for opportunities that you didn't even know existed. Um, I just had to mention that 'cause
yeah. I always think of planning and like building a house. We've talked about this a little bit before, but yeah, you're the advisor, you're the contractor, you're building a house. You need to know what tools to use to build the house. And if I only built just the kitchen or only built just the plumbing, that'd be like me only doing investing, right? So you need to figure out, hey, we need to build, we have the fixtures, and we have the carpet, and we have the kitchen, and we have the bedroom. So we got to do the water, and we got to do the plumbing for everything, and we got to do the wiring. Like all that's how we build the house. And we also have to figure out what tools do we need to build the house we want for the clients and what their plan is. Like they lay out the blueprint for it. And we're like, all right, we can build it this way. We can do this. We can tweak this. Let's expand this room a little bit because we know that you're going to have, some extra grandkids. Like that's what we're building is the plan. That's how we use it. Right.
Yeah, I like that contractor analogy. I really do. Because at the end of the day, and we're not here as a financial planner to say you cannot do this. At the end of the day, it's your life. I'm not going to
It's basically how do we do this?
do it. And then, like, if it is unreasonable, we'll have the conversation. But at the end of the day, like, I do like that contractor type style because also, in terms of financial planning, it's like we can't do everything. Like we might need to bring in other people to do the plumbing or, so to speak, the taxes. So let's partner with other professionals to really just make sure that you have a really well-rounded financial life and that you feel confident at the end of the day to know everything is in one spot, right? And you have a really good North Star moving forward.
Sweet. It's awesome.
Talk
Anything, yeah. I was like, anything else to add on, to tag on in the back end? We're a little over time, but anything else?
Questions. I think questions to ask your advisor. So I did think about this one. How do you get paid? Right. I think that's a big one. Do you receive commissions or incentives from the products that you sell? What's your financial planning process? Keep that one broad. If you're looking for a financial planner, so to speak, ask them what their process is. You will learn a lot. Just say, what's your financial planning process? And then shut up and listen. And you'll be able to see whether or not they actually have a process to, doing a more holistic financial plan. And then if you're looking just for investment management, what's your investment management process? What's your approach on investments and how you invest long term? And I think that will give you, I think, a lot of, just things to think about. And then also think about like, what's your meeting cadence? How often do you meet? And like, is there a method to our meetings? Like, is there going to be a set thing that we discuss during each meeting? And I think that will give you some guidance and some clarity in terms of like, what is that advisor's offer and how are they going to help kind of build your overall financial life?
Yeah. I think the meetings are important. It's a balance between, I don't want to over encumber our clients with like, hey, we're going to meet every month. We're going to meet every quarter. That's not really the case. But we want to be intentional with it. So I had one firm that I knew about and talked with that they did like a quarterly meeting for like 4 hours straight. I was like, I don't know if your clients want to meet for 4 hours to talk about insurance and estate planning and investments. Like that's a long day. I could rather have like some snapshot summaries and make sure they're meeting once or twice a year. And if stuff pops up, we're happy to meet, obviously. So it's a balance between, yeah, we want to meet, but with intentionality. What are some things that if you ask the advisor, hey, what's holistic planning like? What are some green flags that they might say, or what's some red flags that they might say?
I think like the green flags would be all about the process of what are they, how are they approaching financial planning, so to speak. So if they actually have a defined process, let's just say like um, getting the right data is important, right? It kind of it's not fun for the client, it's not really fun for the advisor, but like what does their data gathering process look like to make sure that they're asking and addressing the right things to be able to build out a holistic financial plan? Then it might differ, right? It really all depends upon the client goals, but is there a process? Like for retirees, a lot of times, like we're talking about what is that goal? What is the lifestyle you're looking to live? Let's then do some cash flow planning. Let's then back into some tax planning. And then let's talk about investment planning. And then from there, like the list kind of goes on and on. I think it should be catered to the person, but I think it should be a very defined process depending upon the goals that you're looking for.
Sweet.
Yep.
Awesome. Cool, man. Anything else to end it off?
This time went by pretty quick. Uh,
Yeah, it flew by.
uh,
Well, obviously we're passionate about it because it's what we've been in for the past 10 years. So we've seen a lot, and you and I both have had a variety of experience, and the good, the bad, the ugly, of big firms, small firms,
oh, yeah.
more insurance-based firms, more finance-based firms, more tax planning firms. Like we just have so many different flavors. I'm able to see kind of behind the curtain on a lot of things, and you as well, right?
Yeah, my hope that this like podcast, this video just helped provide people with like a little bit of, clarity in terms of the offers that are out there and hopefully like an action plan in terms of like what to look for, what questions to ask so that when you are, being onboarded or you are kind of trying to find that next partner for you, you feel really comfortable and confident in signing up and making sure that you have the best offer for you and your family, because we both know, like, it is a huge decision. And there's a lot of, emotional and financial impacts to it. So I just want everybody to feel comfortable and confident in the advisors that they're working with.
Awesome. That sounds great. Well, like I said at the beginning of the podcast, if you have questions
Yep.
or want specific things answered, put it in the comments or just email at contwealth.com. You can go to our website, get in touch with us there. But besides that, we appreciate you guys tuning in, and we'll see you in the next episode.
You guys.
Thanks for joining us for another episode of Retirement Done Right. To learn more, visit us at contwealth.com.